If you have been catching the recent news, you would have known that the US Federal Reserve is now more open to cutting interest rates soon after it has reached and stayed at a 20-year high of 5.3%. But the question is, do you know which are the REITs to buy when the rebound starts to kick in? In this video, we're going to explore what analysts are saying as well as the top few REITs based on my criteria. Let's go. Both the US Federal Reserve and the analysts are hinting towards cutting interest rates due to three main things. First one, the inflation is cooling down. Number two, the economy's growth is moderating. And number three, the most important one is that the job market is slowing down. So all these factors come into play where the Federal Reserve is saying that we need to cut soon to prevent the economy from going into a recession. But first, let's talk about why interest rate cuts are implemented. Okay, so basically, in the central banks are tasked with a tough job, right, of growing the economy at a healthy rate. Okay, which means a sustainable rate, maintaining the inflation that's not too high for consumers, but at the same time, okay, not keep interest rates so high to the extent that businesses like this are going bankrupt. Okay, but why are the interest rate cuts such a big deal for REITs? So, well, when interest rates go down, the borrowing costs for our REITs decrease. Okay, so they have a cheaper cost of debt, and in turn this can lead to higher profits and then often lead to better returns for investors. You think about it, so if they have they need to pay lower interest payments, right, then they can churn out more profits and then they can translate to better DPU, distributions per unit, which means that investors can get a bigger bang for the buck now. And then the last but not least, the lower interest rates will make REITs more attractive compared to other, safer fixed income products, be it the Singapore government bonds lah, the T-bills or fixed deposits. Okay, all the banks giving 3.53% and all that, which will also drive up the prices of the REITs itself. So all in all, right, when the interest rates are cut, it is a big deal for REITs itself. Already, we are seeing a lot of articles and reports being written on how Singapore REITs can rebound after 2 long years, okay, ever since the interest rate starts to increase. So now that interest rates are going to normalize, hopefully, right, there's some revival signs of Singapore REITs again. Now let me show you what some of the analyst reports or the news sources are saying. If you have enjoyed this video thus far, I will greatly appreciate it if you can help me to smash that like button, subscribe to my channel and ring the bell so you get notified every time I release another stock analysis video. So there are many reports being written, but I have cherry picked 3 of them to show you here. Alright, the first one is from UBKHN, right? And they are talking about REITs from their regional morning notes. And what caught my attention is this, where they expect the Federal Reserve to cut interest rates starting September or November. And given the high correlation between Singapore and the US, SGD is likely to be near the peak as well. So what is it got to do with Singapore REITs? Okay, if you think about it, a lot of the REITs that have overseas properties, when they convert their overseas distributions, right, all the rental income back to SGD, you are always suffering from what they call FX depreciation. Okay, so given that if the Singapore dollar is near the peak and maybe going to come down, it bodes well for all these properties. With the S-reits that have overseas properties. Okay, so this is the first report. Okay, so now moving on to the next report is from Philip Capital. Okay, they also have this Singapore REITs monthly report, and they remain overweight on S-reits but are selective, and they favor REITs with a healthy balance sheet, strong sponsors, and improving operating metrics, such as REITs in the hospitality and retail subsector. And what caught my attention for this report is actually over here, okay, where they put it all together, the S-reits index price to NAV, okay, which if you can see here in 2024, it is below 0.9 times, so maybe 0.86, 0.87 times, and that is like a, a rebound from the end of 2023, but still very much still at rock bottom as compared to the past 10 years, all the way to 2013, when the REITs are trading at 1.1 to 1.2 times on average for the whole index. All right, so right now it's already at negative 2.1 times standard deviation, which means it's quite at a low stage lah, 0.85 times. Okay, and the other figure, okay, which they also very helpful in showing that the forward dividend yield of 6.5%, okay, is like also at the not bad number lah, okay, at 2024. Okay, what we have back then was around 7% when it comes to end 2023. Okay, this is where um, the prices went down very low, okay, in the COVID period, or it's like when they first started in 2020, 2012. So basically, we are at that very good period of time where the price to NAV is at rock bottom, and the forward dividend yield, okay, of all the REITs index itself is at least 6.5% on average. And the last report is none other than the DBS Group research, okay, and focusing on the second half 2024 outlook. All right, this report itself is 41 pages long, and they talk a lot about other countries, like the regional markets and all that. But I'm not gonna dive all into that. I'm gonna just focus on the interest rate story as well as the REITs to benefit from it. Okay, so what they say is that right now, okay, we are in the final chapter in the higher for longer playbook. Okay, they see the interest rates will transition from this context to slowly decreasing in the second half of 2024, and they see that it will continue decreasing by 25 basis points each quarter for the next 6 consecutive quarters. And with that, right, DBS is actually seeing a shift from the banks, which are beneficiaries for the past 2 years, to those benefiting from the rate cuts, which is the REITs, the growth stocks, and the cyclical stocks as the second half unfolds. And on this point, I actually saw this outlook and strategy from DBS Group Research, that they are saying that the funds rate will come down, and they actually plot the dotted lines and predict, okay, or either project that they are actually going to drop from the current rate to 5.25% this year, 1% drop by the next year to 4.25%, and following which another 1% drop in the year 2026 to 3.25%. So I'm not sure whether they are too aggressive from TBS projection wise, but for me personally, I would want to stay on the safe side. Okay, I would say that maybe they are not gonna be so aggressive on the rate cuts, and I will still want to look for REITs which are able to perform well even during this kind of high for longer interest rates environment. So, although all the REITs can perform well in low interest rates environment, there are still some things I look at when it comes to selecting one of the best REITs. And number one is the favorable sectors. Okay, there are few sectors involved, but I tend to gravitate towards logistics, data centers, and hotels. The reason is very simple. So the three of them have the trends that support their growth. Okay, logistics, you have e-commerce. Data centers, you have the data boom supported by AI or social medias. Hotels, you have tourism sectors, Taylor Swift concerts and all that. Okay, number two, gearing below at least around 40%. Okay, this is very simple because although the government stipulates 50% for REITs itself, 40% gives like a bandwidth, okay, for the REITs in case the valuations go down, or let's say they want to buy a property and they don't have enough money, they can at least have that headroom to do so. Okay, and the third one is the cost of debt must be below 4%. The lower your cost of debt, the the more that you can pay off as distributions. Or in other words, right, you can also say that the credit analysts, okay, in the banks, or the lenders, take it as your assets, your REIT properties are of higher caliber, higher quality. That is why they are able to give you lower cost of debt. Okay, and the fourth one is the yield. Okay, distribution yield of near to or at least 6%. So if you were to compare it to other fixed income products, be it the bonds, the T-bills, all that, they can really give you near 4%, right, without any risk, or very minimal risk. And why would you, maybe get a 5% yield, that kind of thing, or 3% yield, investing in REITs that you have to worry about a different matrix involved? So what I would say is, I would tend to go for some REITs that will give you a higher distribution yield. Make your time doing all this research worthwhile lah. Okay? And without further ado, here are the three REITs that I am looking at right now. Number one, CapitaLand Escort Trust, right? The largest lodging trust in Asia Pacific, with a property value of 8.7 billion as at December 2023. Second one, Fraser's Logistics and Commercial Trust, where there is a portfolio comprising of at least 100 industrial and commercial properties across five major developed markets. So that is really a lot of properties. I would say that it's quite diversified, right? And number three, Mapletree Industrial Trust, one of Singaporeans' favorite REITs, with over 50% of their portfolio now towards data centers. So last time was like they want to maybe focus on the business parks and all that, so they are shifting towards data centers. Okay, so all these three REITs are what I like and are looking at right now. But I'm not gonna dive into these three REITs in this video because it's gonna take a long time to go through their presentation slides one by one and explain why I like and what I like about them. Okay, so if you want to see a part two of this video where I go through these three REITs, you know what to do. Hit the subscribe button, okay, and ring the notification bell so you never miss another video when I release. Now back to you. Do you think that the rate cuts will be a game changer for S-reits? And what REITs are you interested in? Let me know in the comments down below. Next up, don't forget to check out this video over here if you have another few minutes to spare. And I will see you next time. Thanks for watching and ciao.